Retirement will be everything you ever wanted. This is one of the many lies you're told. In fact, there are 7 I routinely see folks believing that can take you from a retirement of your dreams to a retirement you dread. But there's a better way. Here's a recent plan we worked on for Mike and Sarah. Names changed, of course, as they get ready to retire. When they stop working, they'll need to withdraw income from their investments, like their IRAs and taxable brokerage account. In doing so, many retirees default to withdrawing from their brokerage account first, which keeps taxes low initially. It can lead to this false sense of success. But what's waiting is a tax bomb when they start withdrawing from their pre-tax IRAs, most of which was saved up in a 401k. Well, we created a multi-year tax plan so we can determine the optimal withdrawal strategy. And in this case, we're using a strategy of Roth conversions that's projected to save them $943,000 in taxes over their lifetime. If we put that in today's dollars, it still shows you that it's a large amount at $377,000 of savings. Now, Mike and Sarah have saved well with just under $2 million, but that's a lot of taxes to save. Tax planning does not need to be just for the ultra rich. And yes, the US tax code is thousands of pages, but it's structured with incentives intentionally. The tax code may be littered with pages, but your planning doesn't need to be complicated. For example, if you're giving to charity, are you just writing a check? Or are you giving from your IRA or giving appreciated investments? Often just shifting how you give can save thousands. There can be such a focus on getting your income and your investment returns as high as possible, but remember, it's not what you earn, it's what you keep. If you're not planning to save taxes, you're leaving the IRS a tip, and it's a major reason why people also have trouble with lie number 2. Retirees don't spend, and you should. Yeah, that's right, spending. A financial planner just suggested you spend your money. I had a client recently share, I want to enjoy what I've worked hard for, but I also don't want to run out of money. That's not the first time I've heard that, and it's completely valid. The key to finding the right balance is by having a plan for your money that projects into the future. No plan or estimate will be perfect, but it can give you guidance. And then update that plan. That's why when we have regular strategy meetings with our clients, we're continuously looking forward. We discuss, are you on track based on what's changed? And do we need to adjust any strategies, either because of what's changed in your life or because of external things like big tax law changes or a declining stock market? Because running out of money is potentially so devastating, people lean toward frugality, but often when they don't need to. And I'm not ripping on frugality in itself, it can be good. Where it becomes a problem is when experiences are missed unnecessarily. Like when you can spend, but you don't think you can. This is a problem that comes from a lack of clarity and confidence, which is solvable. Now, just because you can be spending doesn't mean you can do whatever you want when you want. The beginning of retirement is the honeymoon. Being free of commitment or routine can seem like freedom. Perhaps you need a stress break from work. I find that most of my clients who sustain their success in retirement do find productive ways to use their time that creates fulfillment and purpose in their lives. They have a routine, a daily structure. Now, it may not be as regimented as when they're working, but that's okay. They do have something to wake up to. The honeymoon eventually ends, and without creating a productive lifestyle and community around you, that loss of purpose can sneak up on you, as can misconception number 4. The average couple expects to spend $47,000 on healthcare in retirement. The actual cost for healthcare in retirement is $315,000 per couple, as reported by Fidelity. And that doesn't even include over-the-counter medications, most dental expenses, and potentially the biggest cost of all, long-term care for daily assistance needs. In other words, healthcare is a huge retirement cost. Expectations are misaligned with the total cost. Not only that, but older adults are not doing anything to help themselves. They're simply not active enough, which worsens their health and increases their costs. The American Family Physician reports relatively few older adults in the United States achieve the minimum amount of recommended physical activity. It goes on to say the medical costs for inactive adults are substantially higher than for active adults and increase with age. The New York Times actually put some actual numbers on this issue. They report that people who start to exercise before or during middle age typically save anywhere from $824 to $2,874 annually on healthcare costs after retirement. And the earlier they start their workouts, the greater those savings can be. Lie number 4 is your money is more important than your health. But if you don't want to worry about your money, get active. Health is your great wealth, but that's nothing if you don't have the right mindset about retirement. See, misconception number 5 stands out at certain times. We've had lots of dramatic events over the last 25 years. COVID, the tech bubble bursting in 2000, and the greatest financial incident of all, the great financial crisis in 2008. In 2008, everything came crashing down across all stock sectors, the housing market, and the job market. It was dangerously bad. And people were worried, especially in those in retirement, because they couldn't just go earn another paycheck. Here's what I observed during that time, a different and positive perspective based on 2 factors. One was with people who had low or manageable debt. Remember, this was a debt crisis, and people who didn't have high debt burdens just didn't seem to have the same anxiety level. The second thing was a contentment from those who were generous with their money. That's why this lie, my money is mine, is actually costing you. Because here's what I noticed. The warm, fuzzy feelings of giving to others wasn't the only reward. Generous people had a different sense of contentment that led to wiser, more objective decisions. They had less trouble staying the course. When the focus is on others, people seem less caught up in their own emotions, which in times of economic distress can lead to wise decision-making when others are panicking. Removing yourself from the emotion can allow good decisions, which is why lie number 6 is important to recognize. So yes, your barber's always going to tell you that you need a haircut. So that may sound a little like what I'm going to tell you next. But here's the thing. You can ignore your barber and cut your own hair. The front may look good, but you can't see the back, at least not well. Retirement is not a set it and forget it issue. It's a journey. You'll encounter new things, and as mentioned, your plan should be dynamic, requiring you to adjust your strategies for life's changes, as well as tax law and economic changes. And when adversity hits, personal or economic, no one can be objective with their own money. Everyone in retirement should seek out financial advice. Do you think that's true? Tell me what you think in the comments. And while every so-called financial advisor out there is not so good, there are many quality advisors, ones who genuinely and competently can be on your side. A good advisor will not dictate you, but rather collaborate with you through the journey. And misconception number 7 is a great example of how getting the right advice can help. Almost all retirees should have conservative monies invested in high-yield savings, CDs, treasuries, high-quality bonds. These assets can serve as your reserves for emergencies, but also to help stabilize your income for multiple years into the future. Like I've mentioned, we've been through some economic rough times over the last 25 years. But playing it too safe with your money carries its own set of risk. Finding the optimal balance of conservative investments and growth investments will be a little bit different for everybody, but you can find the right plan that you can stick to help meet your goals now and into the future. See, most retirees need to aim for growth with a part of their investments. This historically is done through equity investments. That means stocks and real estate. Yes, you'll see more fluctuation in the value of these investments, but pairing them with your conservative investments properly means if the value fluctuates today, it's not an issue, because that's why you also have your conservative investments. See, optimism is paid off, and an overly pessimistic view of the future, being too conservative, can carry its own set of risks, like not keeping up with inflation, which can cause your cash flow to feel tighter and tighter over time when it's too late to make up the growth you need. My partner Alex posted a fantastic video outlining how to invest in retirement. You can catch that link above or in the description below. Thanks for watching, and Alex will see you over on that video now.